All right then, I think we're ready to get started, Brian. So I'm going to stop sharing my screen.
Okay. Can you hear me okay?
You get the full moving humans version rather than the static version that we have on the PowerPoint slide. So good afternoon, everyone. Good morning, depending on where you are in the world. I hope you're all safe, and I hope everybody's doing well in the current lockdown. I know a lot of places are easing their lockdowns now, so hopefully people are getting out and about. So thank you for joining us for today's webinar. I think we've got a very, very great, really good subject today. A series of webinars that we've been running through the whole, through this whole period. I think we've got a very unique view of the world today from that rarefied air from the boardroom. Financial crime has been a high priority in most boardrooms, as you all probably know, for the last few years. Particularly over the last few years, it's very much become moved up the agenda. And I think there's a lot of publicity. There's been a lot of media around that. Only last week we saw the report published from Westpac in terms of their independent review, and I think the board got a good mention in there, definitely. And we're not necessarily going to spend a huge amount of time looking at that, but I think there's definitely some lessons learned. So I'd just like to introduce Brian. So Brian is the chairman of the board at Investec UK, and he's also served as a non-executive director on other boards in financial services. Brian, I don't know whether you want to give a little introduction in terms of your experience and why this is relevant to you.
Thanks, Paul. Yeah, just a few words on my background. So I'm a career banker. Spent my executive career at 3 institutions, Barclays, Deutsche Bank and RBS. And since that time I've become a non-executive director and have spent time on a reasonably variety of boards with international areas of experience. My first was at the Agricultural Bank of China in the UK, as the Chinese banks were expanding their UK presence. My second was with Deutsche Bank in the Netherlands. And the third board I joined was Investec Bank PLC, which, as many will know, was a bank founded in South Africa, but Investec Bank PLC is a UK regulated and UK domiciled bank. And then finally, I joined the board of Westpac Europe, which is the European company that holds the licensing arrangements for Westpac to do business throughout the European community. So a reasonable amount of international experience. I did spend some time in my early career in Asia, based in Hong Kong, but working with throughout 16 countries in Asia. And earlier than that, I did spend some time working in New York, so working on Wall Street. So a reasonable balance of international and UK domestic experience to draw upon.
Yeah, definitely. So an eclectic mix of organisations there, and I'm sure they all had their own unique challenges. So my first question really is just about financial crime. Clearly, we've seen it moved up the agenda for banking executives over the last 10 years or so. But how have you seen the subject of financial crime evolve in terms of the board representation?
So I think you're right to light upon the last 10 years, because if you look at other risks in banking, things like credit risk and market risk and reputational risk, those issues have been around in the banking system for a very long time. Banks taking credit risk have been around for hundreds of years. But the recent focus, and I would say principally over the last 10 to 15 years, has put financial crime very much in the headlines. And it's been a change for bank boards to have a new category of risk. And in a sense, this has been brought about principally by new legislation. It's also followed by new regulations that impact the world of financial crime. But what that means in practice is it's put the banks very much in the front line in terms of being one of the protectors of society against the proceeds of financial crime and financial activity and terrorist activity and so on, which is a new role for the banks. And that has only really happened in a significant way over the last 10 to 15 years. And this in turn has led to society generally having quite a high expectation of how banks should contribute to society in respect of defending society against financial crime. And so all of those things have come together to raise the issue up the boardroom agenda. But it's also worth remembering that most boards, most individuals only really have about 10 years experience in this area of risk management, whereas a lot of us might have 50 years of experience in dealing with credit risk, for example. So it's a relatively new discipline, and it is a continuing its development as a discipline, but it's also evolving quite quickly because we get new regulations coming out of Europe, for example, reasonably frequently on the area of anti-money laundering and anti-terrorist financing and so on. So a fast-moving area, but one that has a lot of expectations placed upon the banks by society at large and by laws and by regulation.
Yeah, no, definitely. I was reading somewhere that apparently the term money laundering was coined in 1973. So it's amazing that it's taken so long to get up the agenda, isn't it?
Yeah, I would say terrorist events in the US have been the spark, if you like, for raising that profile of that, because seeking to locate where the financing of terrorism activity came from was one of the key issues after 9/11, to make sure that these issues could be defended against within the financial system. So I think there's lots of reasons for the impetus for that. But there's been other areas of law that have changed, like a crackdown on bribery and corruption, for example, the proceeds of crime, the fight against drugs. There's been a whole area of legislation and criminal activity where this has all come together to put more focus on the banks.
Yeah, no, definitely, and as you say, the focus has been squarely on the banks, you know, to provide the controls and the access points to that money, right? So I don't know how many of our audience have either sat on a board or ever presented to a board. So I think what would be great for them would be for you to give us a view of, you know, exactly how the board works. And just briefly describe some of the processes around, you know, specifically financial crime in respect to the board.
So I'll focus on banking boards. They are in a little way slightly different to other commercial entity boards. The principal difference is that most banking boards have a much more stringent focus around risk matters. But so a banking board in the UK is principally made up of two categories of individuals sitting on the board: the executives that run the bank on a day-to-day basis, and the non-executives that are there responsible for governance and oversight of the bank in the interests of all the stakeholders. Sitting beneath the main board, there are a series of committees that deal with various things, but for the purposes of this topic, the two committees that have the most impact on how the bank is governed in respect of financial crime would be the risk committee. And in some cases, banks may not have it. If they're very small, they may not have a risk committee, but they'll certainly always have an audit committee. And depending on the size of the banks, matters relating to financial crime would either flow to the board through the risk committee, or they would flow to the board through the audit committee. In a way, it's a function of size, but let's assume it's a reasonably sized bank. It would have a risk committee, and within that risk committee, the committee would have an agenda that would be considering all aspects of risk as it impacts the bank, and financial crime would be one of those areas of risk that would be flowing through the risk committee. It would be one of several areas of risk, as you can imagine, because banks run credit risk and market risk and reputational risk and country risk, and you know, you could go on for a long time. So in terms of the place on the agenda, it would probably be amongst one of 15 areas of risk that the risk committee would be looking at. And then when it got to the board, it would be embedded, you know, the consideration of financial crime would be embedded within the report that came from the chairman of the risk committee to the main board, and it would be the chairman's responsibility to make sure that all the key matters of concern would be raised at the board level. And it ultimately is the responsibility of the board to run the bank. So ultimate responsibility, if things go wrong in the world of KYC and AML, end up at the bank level. And as we've seen in some recent examples, that has resulted in some cases chief executives and chairman leaving the organisation because of some failure that's happened, often deep in the infrastructure of the organisation. But that's broadly how accountability and flows of information work coming up through the organisation in relation to KYC and AML and financial crime generally.
Got you. And what about the types of what are the types of issues that get discussed at the board? What types of issues do get raised, and how do they get tracked at board level? So
part of any risk committee and therefore any bank is to set risk appetite, and the risk appetite that the bank sets regulates, broadly speaking, what the risk return profile of the organisation would be. So how much risk you're going to take in various categories, and therefore what your return expectation would be for taking that risk. And some of those risk appetites, are well practiced, well known. So if you took credit risk, you'd have a certain amount of investment grade risk, you want to take a certain amount of sub-investment grade risk, and there would be lots of details surrounding that. And it is generally a fairly well practiced area. When it comes to issues around financial crime, the simplistic answer is that you don't want to take any risk around financial crime because the penalties of taking risk are enormous. But the practical answer is that if you look at the world and the profile of A, your products, B, where you are in the world, and C, the profile of your customers, the chances are you will be taking some level of risk in financial crime, because the way the world looks at financial crime, it classifies certain countries as higher risk than others. The way the regulator looks at certain products, it classifies them as a higher risk than others. So, for example, trade finance and correspondent banking is, broadly speaking, seen in the eyes of UK regulators as higher risk from a financial crime point of view, whereas domestic lending in sterling to domestic customers is, broadly speaking, it's perceived to be a lower risk area, for example. So whether you like it or not, you will have a profile of risk that you take. And part of what the discussion is about when it comes to KYC and AML is how much risk do you want to take. So how many risk-free countries do you want to be in? How much risk do you want to take in your perceived product profile? And how much risk do you want to take in relation to your customer base? And as is well known, you look at some of the lists that the US have published in recent times about the sanctions they're placing against individuals. There's a fairly clear direction of travel about which countries are impacted by that, so that has a consequence for your customer base.
Yeah, no, absolutely.
So those areas of risk profile feature quite a lot. So the board establishes the amount of risk it wants to take. Then it expects the executive to go away, discharge their responsibilities in accordance with that risk profile. Now, the focus of attention is often about if something happens that moves either the risk profile of the business closer to our tolerance level or beyond our tolerance level. And that's where a lot of the focus of attention is.
Yeah. Yeah. And presumably you include regulatory risk in that risk profile as well as financial crime risk, right?
Of course. I mean, that's one of the areas. And again, the complexity of regulatory risk depends upon where you are in the world. Yeah. If you're just a UK bank operating in the UK, your regulatory risk is principally against the UK regulatory framework. But if you're in 53 countries around the world, you have a much more complicated regulatory risk framework.
Yeah, no,
but on the other hand, you should also not forget that if, for example, you may not have a presence in the US, but if you have customers that trade in dollars, you have exposed yourself to a regulatory risk in the United States because you are dealing in dollars.
Yeah, exactly.
So it may sound simple at the top, but it's quite complicated beneath.
Yeah, the old argument that US sanctions are effectively global sanctions, right? So yeah. So the other thing I suppose that's changed, quite considerably in that same time that we've seen financial crime come up the agenda, is the constitution of boards has changed quite a lot, particularly in banking. How do you think that has been, how that's affected how financial crime risks have been viewed and assessed and understood, I guess?
So coming back to your first point, that this is a 10-year-old, broadly speaking, industry. If you went back 10 years ago and looked at bank boards, you probably wouldn't find amongst, say, the non-execs much experience of people who had had exposure to financial crime, if you like, business examples that they could draw upon in the way that they regulated and guided and oversaw the development of the bank. And if you take post-2008, the financial crisis, one of the criticisms that came out from, broadly speaking, a number of regulators around the world was that the oversight that was given to banks by the board as a whole was not deemed to be sufficient to deal with the risks that they were taking. And I know that may have at that time related principally to say, did they understand the amount of subprime risk they were taking and the consequences of it? But actually that lack of understanding of the risk profile of the organization has been broadly extended to make sure that if you're the chairman of the bank, and that one of the chairman of the bank's responsibilities is to make sure that the skill set and the experience base sitting at the boardroom table is sufficient to be able to guide the bank for all the risks it's taking. One of the burdens that's placed upon you is to make sure that all of the significant risks you can evaluate effectively. And that has meant that there's a need for education and training of the board, and particularly here I mean the non-executive directors. The executives are, broadly speaking, appointed on the basis of their knowledge and experience that they have gained over a period of time in the current environment. Mm-hmm. Non-executives have been probably, a lot of them, out of the banking world for anything for 1 to 7 or 8 years. And therefore there is a continual need for education about what is happening within the world to make them current so they can evaluate. And this has been coupled, of course, with what I would call a broader call for diversity on bank boards in a general sense. Diversity in terms of gender, diversity in terms of ethnicity, diversity in terms of experience, and diversity in terms of ability to evaluate matters from various perspectives. So when you now look at a bank board, it is a very different beast to the one you would have seen certainly 20 years ago, yeah. With a much broader range of experience and a more depth of knowledge about the key risks that the bank is taking and how to evaluate them. Yeah. And this does mean that, for example, on one of the boards I'm on, we run a directors development session every quarter where we educate the board on current issues and developing issues that are coming down the pipe. Things like the quantum internet and things like this that could have an impact on how the bank is run in the future.
Interesting. Yeah, quantum computing. That's a topic for a whole new webinar, right? Yeah. So obviously, education's key. So understanding the risks, understanding what's important to look at. I'm assuming then, I would say, how well do you think those financial crime risks are represented to the board? Do you think they have enough information? Do you think that, the reporting is at the right level for those sort of people to understand the issues?
So I think it's an area of continuing development and evolution where, because the industry of reporting on this is so young, and because the legislation that affects it is so recent, it is a continuing and evolving area of reporting. And it still needs improvement, in my judgment. And I think there are some interesting challenges associated with this category of risk when you compare it with other categories of risk that bankers may typically be exposed to. So if you look at things like credit risk, then you have a portfolio approach where if 99% of your portfolio is, high risk, you can tolerate a small piece of it being, if it's low risk, you can tolerate a small piece of it being high risk. And you have a portfolio approach and you judge and look at the whole portfolio, and you can sleep at night if you've got 5 or 10% of the portfolio at a higher level of risk because you've got a higher level of return for that relative to the lower risk piece. This is not quite the same when it comes to financial crime, because it is, broadly speaking, the 1% or the 5% that's going to end you up in jail or in a fine or losing your job. And therefore, the tolerance that you might have for that in a credit risk world versus the tolerance you would have for it in a financial crime world, the view of the world is very different. Yeah. And therefore, the problem in if you like, the financial crime world it's the needle in the haystack that's going to get you into trouble. And if you're on a member of a board, you can't spend your time looking for the needle in the haystacks, because if you did that, you wouldn't be doing anything else, and you would be interfering in the management of the bank. Right. So what you have to do is to have mechanisms and reporting in place where, if anything within the organization changes significantly that might point to an elevation of risk from a financial crime point of view, either in a subsidiary, in a product area, in a certain geography, or any key element of risk, then you need to have your antenna working well so that that can be picked up and examined, and not only examined, but that until it is remedied or satisfied, it doesn't fall off the agenda in any shape or form.
Yeah. I was going to say one of the points I think raised in the Westpac report was allowing issues to drift. I'm kind of paraphrasing there, but presumably that's one of the key areas, isn't it? Is ensuring that that the importance of issues are understood and that they're resolved, in a timely fashion, right? Yeah,
I mean, if you compare it to credit risk, you have an event like COVID-19, which creates higher areas of credit risk in your business. The board sits down and develops a policy for tolerating that, because it may be temporary, and there may be ways to resolve it, and you've got some government support to help mitigate those risks, for example. If you compare that to, say, something that develops in a country around the world that is high risk, and you are consciously taking a higher level of risk there than you're comfortable with, it's very difficult to say we tolerate it. The answer is, what are we going to do to fix it?
Yeah.
And this is where, how you deal with credit risk with how you deal with financial crime risk. The urgency of resolution is in some cases different.
Yeah. And then presumably is the importance of raising those concerns, isn't it, in that forum, to ensure that that the board is heard and listened to in those scenarios, right?
Yes, and that poses a particular issue, I think, in financial crime, because the area of the organisation where there may be a perceived problem might be a small part of the organisation in a small, relatively inconsequential product area, a long way from the head office.
Yeah.
And by the time it gets filtered through all the systems that look at risk, it might be deemed to be only a small risk. But in small risks in financial crime can come back to bite you. And so the way the filtering system works on its way to the board, and if you like, the way that you set the size of the gap in the filter, so that even small things get through if they're serious, that becomes quite an important focus of how the construct of reporting is built.
Yeah, no, absolutely. Yeah, no, it's a really good point. And what do you think are the other areas that that boards are concerned with in terms of financial crime risk? What other tools do they have, and ways of managing that risk in the organisation?
So, I mean, one of the areas I think that is quite often relied upon in this field is, if you like, benchmarking to make sure that what you're doing is to the highest standard.
Yeah.
And I do mean to the highest standard, because most regulators won't forgive you if you're not operating to the highest standard. And in some cases, the US in particular, the penalties can be enormous if you're not operating to the standard that they deem appropriate. One of the ways to do that is to have external benchmarking done within your financial crime world to make sure that, compared to the market standard, you're operating correctly. And that benchmarking is quite a complex task, in the sense that you're benchmarking how you assess risks in your geographies, how you assess risks in your products, how you assess risks in your customer base, how the combination of those risks are weaved together, how do you get events reported, Does the reporting work effectively? Is the size of the filter set correctly so that big issues flow up to the board? There are two choices about benchmarking. Either you do it yourself or the regulator does it for you. And I can tell you from experience, it's better if you do it yourself.
Yeah, definitely. And yeah, I mean, independent reviews, help in that respect, and you presumably seen those firsthand, right, in terms of how they work.
Yes, and if you like, the one that you mentioned on Westpac in Australia it's a publicly available document that the board of Westpac have made available, that's really sets out how they have reviewed the issues that came about as a result of the inquiries into their KYC and AML procedures. So there is a very current and, if you like, in the public domain document about how those things can be looked at. That particular document is quite pertinent to this conversation because they did look at it in terms of board responsibilities and so on and so forth. I think one of the interesting observations that I would have, not particularly about that report, but broadly about financial crime in total, is that you can have quite a good risk culture, you can have quite a good culture as an organisation, but that doesn't necessarily mean that things can't go wrong. And in the case of financial crime, some small things can go wrong, but the small things can have big consequences. In the world of credit risk or in market risk, if something big goes wrong, the whole board knows about it within 24 hours. Because, if there's a trading loss, board members are told about it and explain why it is. If a big customer goes bust or falls over unexpectedly because of fraud or something, A, it's in the press, and B, the board knows about it. But in the world of financial crime, something small can be apparently small can be going on, but the underlying crime might be something that the world is concerned about. Yeah. And you as a bank may only be a small piece of that, but the expectation is that you would pick up on it. Yeah,
no, absolutely. And presumably the other areas that, so technology plays a part. Again, that was mentioned in the Westpac report, although I feel that the media overplayed that a little bit because I think that was relatively minor in the whole scheme of things. But be interested in your view on technology and how that plays a part in
yeah, and it clearly plays a part, and increasingly I would say things like data science and data analytics and artificial intelligence will play a bigger role in the field of detecting abnormalities within the world of financial crime. And those technologies should help the banks to establish what is a normal pattern across a product area, a geography, or a particular customer's activity. But that information obviously has to be supplemented by what you know internally about your own strategy, by what you can learn externally about certain behaviors and certain trends within the market. And this is particularly relevant for when you're looking at customers where their risk profile might change because of something that is reported or something that is inquired upon by proper regulated or legal entity structures in some country around the world that should put you on alert at the very minimum. And bringing that information together using technology is something that we now have at our fingertips that we didn't have at our fingertips 10 years ago.
Yeah, no, exactly. And clearly, machine learning, AI is starting to play a part in that. And I hear that a lot mentioned in financial crime. And clearly the FCA have made a point of saying, to your point about understanding new technologies, that boards need to make themselves familiar with AI and actually take some responsibility for it in an organisation.
It's another related topic about boardrooms and about board experience, but it is broadly true that non-executive directors go into that line of work at the latter stages of their career. You don't normally have 17-year-old non-executive directors. And so what you tend to have is, the areas of technology that are developing fast are not necessarily at the fingertips of the people who are the non-executive directors. I could take, you could take artificial intelligence, if you like, as an example of it. And if you think that artificial intelligence is going to be the savior of lots of things, you're wrong, because it can have its own biases built into it by the people that are programming it, and the machine learning therefore can relearn those biases and accentuate them over time. And if you had a financial crime bias built in there in some shape or form, you would end up making mistakes on the basis of that artificial intelligence. So it's not a panacea for all sins, and you have to be, when you implement artificial intelligence, you have to be careful about how you do it. And given that the board is ultimately responsible for everything that goes on, that's one of the key areas, for example, that they have to be in touch with.
Yeah, no, absolutely, absolutely. I just want to let people know there is a Q&A function on the webinar. So if people do want to ask questions, you know, Brian has kindly agreed to do Q&A at the end if you have any burning questions. So please feel free to put them on there, and I'll read them out. I guess the other area I wanted to focus on, and you know, this could be a can of worms, but I wanted to ask your thoughts about culture and how important culture is. Firstly, you know, in the board, in financial crime, you know, and your views of what you've seen in that space.
So it's a good area for discussion, because post the 2008 crisis, it was clear, and particularly clear in the UK, where the regulators formed the view that some of the causes of some of the issues within the UK banking system went back to the culture and how the corporate culture was operated, and how rewards and other things promoted certain behaviours that they felt were not constructive. And in particular, one of the areas that they alighted upon was ensuring that the culture promoted the right risk motivators and risk behaviours. In other words, if people were taking risks, they weren't over rewarded or within the culture for taking inappropriate risk, and they were rewarded for behaving correctly in relation to risk. And lots of people think, when they think reward, they think bonus. No, I'm not necessarily talking about bonuses. You're also talking about promotion prospects in an organization and other things. So if someone is continually taking, you know, a lot more extra risk, and the profile of their business is higher risk return, there has been a tendency in banking, those people get promoted because they're getting better returns on equity. And then of course there was a big collapse like in 2008, and it turns out that those higher returns on equity were taken because the full appreciation of the risks that were being taken weren't factored in. And the concept of risk-adjusted return on equity has become more popular as a result of those issues. Those things you can apply in lending. They're much more difficult to apply in financial crime. But one of the key areas that I think has become more important within the mix of how you judge people's compliance with culture is conduct. And so the conduct element of reward and promotion and so on has become a much more key feature of how people within the banking world are evaluated going forward. And of course, conduct is an important area when you look at financial crime. The law demands certain, you know, unequivocally demands certain behaviors from us when it comes to financial crime. You know, and you can take specific examples about tipping off and things like that, but filing reports to the regulator and other bodies about what you know that's going on inside of your organization are actually legal requirements. And so there's a conduct expectation behavior in relation to this area in particular. But there's also, I think, a conduct expectation that is a broader issue, which is there has been a tendency in some parts of governance oversight. I don't just mean in banking, I actually mean throughout the corporate world, that there's a sort of style of leadership is that don't bring me bad news, just bring me the good news, and then we can grow and develop and we can have a good news story sort of thing. And if that is a culture, it doesn't encourage people to come forward with news of potentially a bad thing, potentially even a bad thing happening in the financial crime world, for example. So that's a critical element of the culture of the organization, that, you know, you're not going to shoot the messenger if they come forward with bad news, because in this world there is an expectation, and in some cases a legal requirement to do so.
Yeah.
And so this is what I mean by the right culture allows the right development and growth of the appropriate level of risk management within the financial crime world.
Yeah, no, it's interesting, the good news piece. Definitely, you know, my experience of banking, you know, it's you know, many a time was I asked to try and make the presentation look more positive.
Yeah. Yeah, but I think there's degrees, isn't there? I mean, you want to have a positive element of your business because there clearly are things that you want to spend money on and invest in from a capital point of view. But the balance between the risk and return always has to be a feature of that discussion. Yeah. The other thing I should also just mention in terms of culture, and it's a subset of culture, and it partly applies in what you would call a cost-cutting environment, but it generally applies, is that the financial crime area of a bank has to be appropriately resourced. And appropriately resourced means that they can do their job properly and that there's no skimping when it comes to checking customers, checking products, checking geographies, no skimping when it comes to reporting because, oh, we haven't got enough people, we haven't got enough time. And part of the board's responsibility is to make sure that all banking control functions are appropriately resourced to do the controls that are expected of them.
Yeah.
And of course, one of the things that occasionally happens is that if a board feels that there's a possibility that the control environment isn't appropriately resourced, they might bring in some extra resource, either permanently or temporarily, to try and fix that issue. Yeah. And in this world, you occasionally see that when, for example, if a board perceives that a backlog of annual reviews of KYC and AML are getting too big, then that probably tells you there's not sufficient resourcing on the case and you might want to bring someone in from outside to shift the backlog.
Yeah.
And those are all things that boards have to consider when thinking about what is the right risk profile associated with this part of the business.
Yeah, no, absolutely. I mean, I've worked on many projects where backlog and tolerance of backlog is seen as a key risk indicator as well, in terms of those remediation efforts. Yeah, and it's interesting that you say that it's good to hear that the boards have that kind of level of interest in the resourcing. It's I had the phrase today that came up, and I haven't heard it for a while since I worked in banking, of do more with less. We've seen a lot of that. We've seen a lot of cost cutting. We've seen a lot of paring back of resourcing. Do you see that as a particular risk in terms of some of the financial crime elements that risks that exist in the financial services world at the moment?
Yeah, I mean, I actually see it as a specific risk right now. Yeah. And I say that because the world is about to go into hopefully a post-COVID period where growth in the world's economy is not going to be at the levels it was before this happened. And this means that revenues are going to fall probably in the banking system, and there is a reasonable possibility that bad debts will increase. And it is typically in those environments where you have quite an active cost-cutting philosophy. And so that I think that is a potential risk area. But coming back to the phrase that you use, do more with less, you can do more with less as long as you invest in the right technology to support that outcome.
Yeah.
And a board isn't going to say to the management, do more with less, just get on with it. Let's examine how you can do more with less with the right technology support to achieve that.
Yeah.
And I think this is a relevant topic also in the area of financial crime, because as we know, there's quite a lot of tools being developed currently that can help financial crime work better, which would make the actual activity of financial crime examination less labor intensive and potentially more comprehensive.
Yeah, no, exactly. And now you mention I guess the COVID situation. I mean, we've talked quite a lot in some of these webinars about the additional risks of financial crime in the current environment. I'd just be interested in your views on what you've been looking for as being part of a board through this period. In terms of your focus areas?
So I think there's a focus in making sure that with people working from home, they still have access to all the right tools and equipment to be able to do their job effectively. And and I'm now talking about effectively in relation to the world of financial crime, to make sure that there's nothing that has happened to create a dislocation between the shift, if you like, from a centrally operating to a distributed operating environment. So that's been one of the areas of focus of attention. Obviously, another area of focus of attention relates to security and security of data and security of distributed networks. Because once you move out of a single office environment with a very strong perimeter, you're moving to a distributed world. And you can see that there will be opportunities for criminals to try and exploit that activity. And so that's obviously been an area of focus and concern. But obviously another area of focus and concern is the overall welfare and mental well-being of the staff. From what I can see, I think there was the initial change of working from home, there was a sort of a broad enthusiasm for it because it was different and it was slightly more relaxed and it often suited people's lifestyles better and it avoided risky commutes. But as time has gone on, I think more and more people have missed the social interaction of being in the office with others. And they've also missed the opportunity for bouncing ideas off of one another in what you would call in a very free format sort of way, by sitting next to somebody chatting, as opposed to what is slightly more formalized, which is you're on your own sitting in your home somewhere, and you've got a variety of people looking at you and you're looking at them on a screen. And so I think over time, so I think there's quite a big pent-up demand to get back into, not necessarily full-time, but at least part-time, get back into a working environment that is like the best of both worlds. It gives the flexibility of working from home, but it gives the social interaction that human beings like when they're in the workplace.
Yes, definitely. It's really interesting you saying about the interaction. Something that I've noticed, I guess, over time. I guess it's a culmination of time, like you say. That there's an element of people move to this environment of working on Zooms and Teams meetings. But there's a slightly different energy that you get from sitting down looking at your laptop than you do standing in a room on a whiteboard. Certainly from a personal level, I certainly get a different energy from doing that.
And there's even simple things like walking from meeting room to meeting room in the building gives you a certain lift, and just saying hello to people in the corridor and things like that, as opposed to sitting in front of a screen and, other than making a cup of coffee, not going anywhere really.
And then of course there's all the information that you gather, before meetings and after meetings, and conversations in the lifts or bumping into somebody in the canteen that you don't get from sitting at home, right?
It is interesting, those staff that have gone back into the office post-lockdown, because they are allowed to, and they may be performing semi-critical functions, the feedback of them coming back into the office is that they're disappointed because it's not like it was before. And that's an understanding disappointment, but it's also not surprising it wasn't, because the canteen isn't open, for example. And sitting around washing up your coffee cup, in the kitchen there, you can't really do those things at the moment. So it's quite a different world, and I imagine that the world going back would be some sort of hybrid.
Yeah, no, absolutely. No, it's fascinating. So just in the interest of time, I was looking to see if there was any Q&A. I haven't seen anybody post any questions. I guess the obvious one to ask you, we've touched on a number of things that were in the Westpac report. Anyone who hasn't read it, I advise that they do. I think there's some really, really interesting pointers in there. I think it's remarkably transparent. I think it's a really good report. I think we're about to publish a summary of it, so we can people can have a look at the crib sheet, if you like. What lessons and what takeaways did you take away from that, other than the things that we've already mentioned?
We've touched on quite a number of them, but it's a one of the issues is it's a complicated world, because there was a technology element to that. There was also, I think, a reporting element. So in other words, there were all the right reports going to the board, but not necessarily all the right content in those reports. And whilst it was clear that there was no deliberate attempt to mislead, the net result of not having the comprehensive amount of information in those reports was that some things got missed. So the complex nature of financial crime is illustrated in these reports. So when things go wrong, it's not normally you can point your finger at one thing and say that's what went wrong. It's normally a combination of events, and part of that combination of events is that the KYC and AML type event happens deep in the organization, sometimes in operations, sometimes in missed data being picked up somewhere deep in the organization. And that somehow that's got to reach the board so that it can adjust the board's view of how much risk we're taking and what should we do about it. Now, some of these things will be remedied before they get to board, because management will look at them and say, oh, we've got to fix that, there's a loophole there, and so on and so forth. And so it doesn't necessarily mean everything has to reach the board, but those that are of critical importance should reach the board. And having a framework that allows that to happen, that's the challenge of how you design information flows to a board in this area.
Yeah, no, definitely. I think, like you said, it's an evolving science, isn't it? And it's a newer science in terms of the risk reporting for financial crime.
It's interesting when you compare, if you like, financial crime reporting to a board and cyber risk reporting to a board. They're both relatively new areas of inquiry. They're both relatively high profile in terms of things go wrong. They both get in the press, and you both end up having fines. And if you have data losses, you've got data commissioners and all sorts of people on your back. So in terms of outcomes, they're quite severe and quite high profile. But in general, my observation is that the cybercrime reporting framework has developed more rapidly and than a lot of the areas of financial crime reporting.
Yeah, no, it's interesting. I suppose there's an element of the cyber world, it's techies, dealing with technology, right? And I suppose they're used to, representing it in a certain way and a sophistication of reporting, and financial crime, is sometimes, more of a looked at as more of a traditional type of risk, but actually needs to be reported in perhaps a very different way from the way, in the way you described earlier, right? So be interesting to see how that develops, right? I suppose my last question really would be, you've served on you talked about your experience and the number of boards that you've served on, and now chair. What would your advice be to any NEDs out there, or people who are wanting to become NEDs, or for financial institutions in terms of financial crime?
So I guess my first observation is stay current on this area. Make it your mission to understand what the laws and the regulations in the country that you operate in demand of you as a board. So stay current, and when it changes, stay current. And if the risk changes, make sure that you recognize the risk has changed within your risk appetite view of the world. An example of which would be under the last European directive, there was quite a clear change of emphasis about the responsibility for money laundering activity in subsidiaries of a company in other places around the world, making it responsible for the MLRO back in home base.
Yeah.
And that became a new and very explicit responsibility. And that was in addition to making sure that the local person responsible for money laundering in any geographic location around the world was responsible for making sure that they met the requirements of the local legislation as well. So that's just an example of making sure you stay current on the issues, because they change quite frequently.
Yeah.
The second is treat it like a high risk area, because the profile that you'll get to your reputation if it goes wrong, and potentially the size of the fines that you will have to pay if you get it wrong. There have been some pretty good examples of some high profile banks that have been fined quite a lot of money in this space.
Yeah.
So relative to your thinking about risk, treat it in that way. So have it on the risk agenda in the right level of profile, given that it could damage your reputation and you could pay some significant fines if you don't get it right.
Yeah. Yeah. No, absolutely. And the media headlines that go along with that, right?
Yeah.
You know, it's that's really a big part of it. So yeah, I think I'm going to wrap it up there. So you know, firstly, thank you so much for spending some time with us. You know, I think it's a fascinating conversation. You know, really appreciate your insights. Some really important things there, and you know, some interesting views. You know, a couple of things that I wrote down here. I mean, one of the things I picked up from you, I liked the fact that you used the word higher standard when looking at financial crime. You know, I know in a lot of organisations, when people look at regulatory risk, they don't necessarily look at it that way. So I think that's really, you know, that's refreshing to hear that. Secondly, education. You know, I think that's a key point you've brought across. You've urged people to stay current. I think that's really important. Things do change. Financial, you know, criminals change. You know, financial crime changes, and regulation changes, right? So it's really important that people are educated, they understand the risks, and they understand their responsibilities, right? You know, you talked about technology playing a part. You talked about the independent reviews, and you also made a point around resourcing, and I think that's really, you know, refreshing to hear that again, you know, ensuring that the right resourcing is there to do the job, to make sure that that the banks, you know, stay out of trouble, and also, you know, do their part to stem the flow of financial criminals, right? So yeah, so thank you very much, and everybody else, everyone who joined us, we are recording the session. That will be available. We've got another interesting webinar coming up next week as well. So we have a financial crime professional, Amanda Parmenter from Lloyd's Group is gonna join us, and she's going to talk about specifically the financial crime risks in that they've seen during the lockdown, and also coming out of lockdown, and what that looks like. So you know, we've just talked about your views, Brian, but that'll be interesting to see see those views as well. So thanks very much, and have a good day, everyone.
Thank you. Pleasure. Thank you. Goodbye.